want to modernize it by getting rid of the old white guy on the barrel. And a lot of their customers kind of liked the nostalgic of the guy on the barrel.
Trump may be deciding that it's time to create a legacy through the taking back of the Americas, and I do think we could be seeing the Trump corollary to the Monroe Doctrine. We're not BlackRock, we're not JP Morgan, but we're finding that through the use of AI that we can bridge the gap between what they're doing and what we can do.
And welcome to another edition of Risk and Return. I'm Charlie Gasparino, Fox Business, from the New York Post, from whoever will pay me. I'm here with the, I'm not going to call him the granddaddy of data. He's younger than me. I'm just going to call him the daddy of data. Bob Sloan from S3 Partners. Absolutely the best data company in the world if you want to trade and know what's happening out there. They track long and short interest and a lot more. Bob, I want to get right to it. You have some good data calls this week. And it's interesting. It's Cracker Barrels in the news for a lot of reasons, including getting rid of the Cracker Barrel, maybe the guy. The barrel is still there. By the way, in the old days, there was crackers in a barrel. Apparently, they did put crackers in. I never knew that, but because I someone on set today, my partner at Fox Business, one of the anchors, Brian Brenberg, looked it up and said, "Yep, they put crackers in the barrel." So they got rid of the dude on it. Somehow that becomes a cultural sort of touchstone issue conflict. But we're not going to get into all that. You looked at the data. There's a conflict in the data. Why don't you explain?
Sure. So, well, Charlie, this stock and this story is a clarion call for someone to read your book. I think.
Yes.
This is a classic example.
Go woke, go broke. Yeah, they're trying to go broke. They're trying to go. I mean, I guess they got rid of the guy on the thing because he's a white guy and he was hanging at the barrel. So they want to modernize it by getting rid of the old white guy on the barrel. And a lot of their customers kind of liked the nostalgic of the guy on the barrel. I mean,
I would say more than just a lot. I mean, this got hit millions and millions and millions of times on X. And one of the things that we saw is that, by the way, we talked about this on our show about 3 weeks ago. We said Cracker Barrel is a battleground stock.
Yeah, I remember that. Yeah,
we did. We talked about it. It's a fact. You can look it up. And you could see at the time we're saying, hey, anytime you see the active longs as we identify them, and you see short sellers, and they are more or less in balance, that is super high volatility. Word to the CEO, if you're looking at this data and you see short interest rising, and you see longs getting out of your stock, where longs and shorts are almost equal or pretty close to one another, not a good time to rebrand your company, because your stock price, we can promise you, is at a point of extreme volatility. And guess what happened? Ba-boom.
Ba-boom. How much did it go down on this guy in the barrel get kicked off the barrel?
Take a look. 60 to about 50. I mean, it was 50%. Off 20%.
Oh, that's amazing.
It's off of this news story. But what was happening is that the news story, so one of the things here, data drives news drives markets. And this is a classic example.
Yeah, so now just let me frame it for the viewer. S3's data showed that if all this stock needed was a push,
yes,
something newsy, something hard edged to move it one way or the other, because it was a battleground stock where they were at each other's throats, and the news was a negative for the stock. Obviously, they went woke by getting rid of the old dude on the barrel, and that led to this sort of fairly significant correction in the stock. S3's data would have told you that was going to happen. If you had that on your list, your battleground list, you could have said the minute you saw them going woke along the lines of Target, along the lines of Budweiser, there was going to be hell to pay. Markets hate that right now. I mean, you look on the positive side, Sydney Sweeney ad at American Eagle, the stock did very well. I'm saying held up under a lot of pressure, by the way.
And that's right. And that was another battleground stock where the news and the marketing and your X feed had a direct impact on the stock price. No
Well, let
doubt.
me ask you this, Bob. Should we be looking at should analysts be looking at woke as a potential stock catalyst these days? Keep it on their, like, traders should keep it on their, plastered on their Bloomberg, like whatever. Give me, type into Bloomberg. Give me every company that's going woke, and I'll short the
Well,
stock.
here's the thing. It's not just woke, it's rebranding, right? So I would say it's that if you are looking at abandoning something that has been a long held identifying trademark for your company, and you see that there's $500 million of active longs versus $500 million of active shorts, I would wait.
Yeah, I mean, we should point out that if you know how these things are rebranded, and this is where it gets into some of the topics in my book, Go Woke, Go Broke. The people who are rebranding it are not market experts. They're not, they think they understand sort of segmentations of society that they can sell to. Um, but they also come at it, it's been my experience, at a very political standpoint. They think if they see, they quite frankly, they see white men as something that they don't want to sell to, when in fact, I hate to say it, I hate to get racial here, but white guys have a lot of disposable income. And if you go there, you're going to take a hit. I mean, that's what happened with Budweiser. It wasn't it wasn't so much race on Budweiser. It was their key demo, were beer chugging guys that like girls in bikinis, not transsexuals in bubble baths. You know what I'm saying? It's,
And
you
by the
go
way, that
there,
can happen,
you're gonna
right?
get
And that can happen.
hammered.
And by the way, that can happen for a stock as they rebrand and they try to change their image or they say, hey, we're a little tired, we want to do something new. Our data is not saying you do whatever you want to do, but
Right.
this is a risk. This is a risk that you probably are not aware of that can decide your fate if you're the CEO and the CFO. Your
I
stock
mean,
down 20% is really bad.
something really needs to change on Madison Avenue, on, who's making these calls between the marketing departments, and they're in a mindset that this woke stuff is is sellable. Now, just to back up a minute and just to be fair here, we don't know if wokeness, this was interpreted as wokeness, and this is where it gets
And
really
that's
crazy.
fair,
Is it
right?
possible that they weren't woke? They just said, "Hey, let's get rid of the guy in the Cracker Barrel."
Could be.
I mean,
But
the
you do
Budweiser
that.
example was
Yeah.
downright wokeness, but I mean, is
But you
what it
wouldn't
is.
do it. You wouldn't do it, right? Let's just play CEO for a second, okay? And someone's around the table that said, "Hey, Charlie, you're the CEO of the company. Okay, I'm your advisor." I come in and said, "You know, there's an imbalance here in your stock, right? Basically, you're at a point of 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 real inflection, real volatility. If you're not right, your downside is way bigger than you think." And that's what our data would show you
Do
before you.
CEOs have this conversation, Bob? I wonder.
Not a chance.
Yeah,
No
that's
way.
what I mean. They don't. They
Not,
don't.
not,
They
not a chance. No one,
always.
no one in the IR department is looking at this data going, geez, if we rebrand this thing, it could mean we lost $100 million of market cap today. I doubt that.
They should. Should they be doing that? They should be.
I,
Every IR department in America should be getting the data from S3 data, hiring Bob to figure out whether their stocks are battleground stocks.
and that is why we started the show with Cracker Barrel, because this is a real business case study of market dynamics and the results of rebranding and what to do at the corporate level and the results if you don't understand your own stock price. They can be catastrophic and it can cost you your job and you didn't even know it. I can guarantee you the Cracker Barrel CEO, she is on Good Morning America. She's talking about that. And that she had no idea the stock was going to go down 20%. There's not a chance. And that's not a man or woman thing. It's just no one gave that person
Remember, there was
that,
currency
that
risk.
information.
Remember, people used to list all the risk: currency risk, event risk, political risk. I say woke risk.
Uh, eh, branding risk, branding risk. You could call whatever you want. You can call it woke risk. You can call it branding risk. You can call it marketing risk. You can call it anything you want. But for sure, there are some stocks that have this dynamic where you have active longs and shorts pretty well equal, and they're fighting it out. And you spring this on the world, you better be ready.
Right. And you have a customer base that's likes the product the way it was. It's not
Well,
really into modernizing the Cracker Barrel. Just so you know, full disclosure, I haven't been to a Cracker Barrel in years. I kind of like the country feel to it, you know. And
it's one of these things, I get it. The thing was around for 40, it was around for 42 years. But it fit the meme culture. You're getting rid of something that we really like and we feel for in a way that maybe people that aren't actually polling the people they should are don't understand. And
yeah,
by the way,
it's like
all of that is in the stock price.
imagine rebranding the Waffle House the Crepe House. Not going to work.
It's not going to work.
Yeah, I know. It's crazy stuff. Let's get to Nvidia. I
Oh,
find it.
let's do it.
I mean, Nvidia is such a great stock. But by the way, what is Nvidia? Is that a battleground stock? No, right?
No, but so this is a
It
great,
might be soon.
well, it's a great question, right? Almost definitionally, it cannot be a battleground stock because you have, I don't know, six,
Everybody's
seven
long.
hundred billion dollars,
Yeah.
right? So let's just give everybody a relative value comparison. As we measure it, I think in the U.S. market, there's like $1.4 trillion. I could be off by $100 billion, but don't hold me to that. But I'm pretty close. $1.4 trillion in total shorts. Nvidia's, I think, 36 billion. Okay. The active longs in Nvidia, I think it's something like, I'll say 500 billion, 600 billion. The rest is buy and hold and index and so on. So you cannot have that stock that is that big where the long is 500 billion and the shorts are 500 billion. That would mean the world had just come to an end.
Right.
It couldn't happen.
But there is a growing short thesis that's growing on this thing, and you saw it started to play out a little bit in all sorts of AI stocks. And we just said, we're going to have Robert on in a little bit. Robert Koenigsberger is going to be talking about AI. um, and he's following that and how it impacts, alternative investments and emerging markets. I'm going to save it for him because he's going to say it a lot better than I do. But to counter the bullish case on AI, there is talk. Apparently, Trump just is talking about it now. The need for power to do all this AI that all these companies are
Yeah.
looking to create, and the lines are starting to converge. Like we got power here, and we have the need going here, and it's like where do
I,
you make it up?
you know, we just put the show on, obviously. We just got on the air.
Right.
Where do you think he got that idea from?
Well, I know
I think he reads your column. In fact,
he might have read
sure.
the
I
newsletter.
think he
The
did.
newsletter just went live as we went on the air. It's going to be in the paper as this thing as Risk and Return airs tomorrow. It will be in the New York Post. You can read it online. Yeah, I mean, he probably gets the newsletter. Someone in the White House gets it. I know he reads my stuff, but Trump, meaning he, is now talking about the need for energy. He just said it on the White House lawn or in the White House, need for energy to power this AI revolution, and we don't have it. And if we don't have it, at least now, we don't get it. This AI revolution, there's going to be a correction here, and people starting to talk now. Nvidia, I think, announced does earnings next week. There's a lot of talk about maybe Jensen, the CEO Jensen. How do you say his name? I'm going to butcher it. Um, Jensen Wan, is that it?
I, yes.
I said it close enough, but Jensen's gonna Jensen's gonna come out and talk about this. People are saying it, and it could move the stock. So I just think it's not a battleground stock. It's clearly not a short stock. It's not a meme stock, or this is what's powering everybody's 401k. But I don't know, maybe take some. Is this a time to take profits on this thing and maybe jump back in at some point?
Well, we've had a couple of different situations in the past week that are really interesting. We'll start with Nvidia. We'll go to Palantir. and we'll work our way through. So Nvidia, just to get back to your point, short interest is more or less bounced between 30 billion and 40 billion. It's so many things to so many different people. It's the way to hedge the market. It's the way to hedge, you know, chips, et cetera, et
So
cetera.
as it just it's not a huge percentage of
No,
Nvidia's
it's 1%. I don't
one
even think
percent.
it's 1%.
Okay, so it's less than 1%, but it's big in gross terms, right?
It's the largest short in the US market by a lot.
By
So
gross terms,
by
yes.
gross terms, but that's because it's the largest indexed weighting in anything, whether it's
Right.
S&P, whatever. So people use it to short the whole market. They're not necessarily bearish on semiconductors. But what we have seen a lot in a stock like Nvidia and some of the Mag 7 stocks, um, particularly like Meta, is that the longs, it's really the long side that has gotten tired and has run out of momentum and is running out of energy. So, for example, Palantir, we actually wrote something and said, hey, this is before the stock was down 20%. We said, shorts are gathering some steam here, and there's some rotation. There's some cohort rotation, meaning different individual active investors, different styles are starting to rotate out of this stock. So there was all this talk last week. We talked about it on last week's show about, Apple's a short squeeze, and we just talked about how ridiculous that is. But what was really happening is that the active longs were actually rotating out of the stock. Shorts were starting to increase some of their position. And what happened is that is a classic sign of the loss of momentum.
Yeah.
And that's exactly what happened to Palantir. You had a loss of momentum, and that's why exactly. So long started to sell, shorts made some money. We were on the front page of the Bloomberg Terminal today as one of the most read stories of why that happened. By the way, the short sellers are still down a ton in that stock, but they made a lot in the last couple of days.
So
And
this could be just be temporary with Nvidia. This is just this sort of rotating, the losing momentum and people making a few bucks on the short.
100%. And so that, there's a short-term nature to it. But what we what you and I have talked about is that what's more interesting to us is not necessarily the short interest in Nvidia and or Palantir. It's uh, I would say the energy, renewable
Renewables, yeah.
energy sector and how much the longs have increased in that sector. That's interesting. And that could actually piece together the thesis that says, hey, we're just short power. We're short power. The funding of AI is electricity. We don't have enough electricity to actually fund the growth of AI and get some of the productivity benefits that are already happening across any sector that you're in.
So this might, based on your data, this might be more of a play into the renewables sector,
Yeah,
based on the need for energy. Than, hey, let's start, selling our AI stocks, because AI is probably got a lot.
yeah,
As we're going to talk in a few minutes,
yeah.
there's a lot of legs to this graph.
And and what's also fascinating is that the short interest in Meta went up a lot. Now that is interesting because they're spending so much on AI talent that you've seen a really healthy increase in the short interest of Meta in the last 10 days.
So you think people are shorting it just because of profits? Maybe they're gonna have to pay extra money on salaries. I don't know, or
I can't remember the exact
investments.
number, but the extraordinary pay packages that are going to um, folks that can use AI to garner attention is quite extraordinary. And you've seen a reaction. I think you've seen a reaction to that. And now, could that be, hey, that gets thrown in because we need more electricity? Could be because the longs are tired. It could be because they're spending a lot of money on something that is less than certain.
All right, I'm totally uncertain about it, but until they can write a book, AI can write a book called "Go Woke, Go Broke: The Radicalization of Corporate America." I'm not worried so much. How's that?
I don't think AI would write that book.
Bob, you want to wrap it up there? I think we went through some interesting stocks. We got an amazing guest that's coming up that you're going to bring aboard.
Our very special guest. We're very, very, very happy to have really one of the most interesting people in alternatives, Robert Koenigsberg, the managing partner and CIO of Gramercy Funds Management, a $7 billion alternative credit investment shop. Welcome to Risk and Return.
Thank you very much.
Let's just start hot. Venezuela, ships off the coast. What's your take?
Well, so what's my take? It reminds me of Operation Just Cause in 1989 when Bush decided that it was time to take out Noriega. And there seems to be a lot of parallels in terms of the justification. So it's not about necessarily democracy, no democracy, what have you. Now it's about a lot of parallels, drugs, narco trafficking, what have you. So clearly the Venezuelans are spooked. You know, they've mobilized 4.5 million of their sharpest shall we call it, senior citizens for their task force or what have you. But in all seriousness, I mean, yeah, I think there's two things that may be going on. One, Trump may be deciding that it's time to create a legacy through the taking back of the Americas, and I do think we could be seeing the Trump corollary to the to the Monroe Doctrine, if you will. And it may be part of the whole deal with Putin, quite frankly, which is, you can have the Donbass, whatever it may be, and let's get the Chinese and the Russians out of the Americas.
So,
I'm sorry, go ahead, Bob.
no, go ahead, Charlie.
I was going to say I mean, there are parallels here, but we're talking about, Venezuela is a country of many magnitudes, and then of Panama. Am I right? I mean, Panama had a very small army. I mean, Venezuelan army, I'm sure is not. And we're not talking about the Russian army here, but they're a little more armed to the teeth. You really think we're going to do a land invasion and take them out?
I don't think it's probable, but I do think it's a lot more possible than people are thinking at the moment.
And if that happens, where do the markets go? Up?
Well, certainly the markets that we're focused on, which would be Venezuela and the PDVSA bonds. I think at any point where the markets, catch regime change, bonds would rally big time. You got PDVSA bonds trading at 14 cents. One of the things I've learned in emerging markets with the collapse of regimes is it tends to take longer than you think, and then it happens faster than you thought it was going to happen.
Has there been any movement in those securities late in the last couple of days?
A little bit, the PDVSA bonds moved maybe from 13 to 14 and a quarter. You can say it's a point, but a point over 13 is not immaterial.
Robert, I've heard you say in the past there's a big difference between policy change and regime change. Where do you think that applies the most? If you had to say, okay, here are the 1, 2, and 3 places in the world where actually regime change really matters because it will actually have a different policy. Where would those be for an emerging market investor?
Sure. And, I think what we typically talk about is a difference between a change of government and the change of regime. And you think about it, in the United States, historically, you've had two fairly central regimes, and whether it's the Democratic Party, the Republican Party, whatever it may be, you didn't see a huge change in policy. You go to a place like Argentina, and you go from Kirchnerism to Milei. You've had not only a change of government, but a change of regime, which is a change of a policy set. So, where did we see regimes collapse? Certainly the former Soviet Union collapsing, was a regime change. Argentina mentioned that. And certainly, if Maduro were to fall, what would come would be a regime change.
Right. And so what does that do for the opportunity set that you see? As you describe yourself, you said, hey, it's really hard to judge beta. And the way that we like to make money as Gramercy is through better collateral, better terms, more, I would say, structuring, if I have that right, then let's just say trying to figure out market direction. Do all these things make it easier for you or harder for you to actually enact what you're trying to do?
Look, I mean, I think that's a little bit different than regime change, which tends to be idiosyncratic around a particular credit or whatever it may be. Bob, I think what you're getting into is, in emerging markets, most people have thought about this asset class as kind of yes, no, beta, no beta. They tend to think about it pretty late. Quite frankly, I think, emerging markets have had great return potential, but most investors haven't captured that return. And the difference between the returns that were present and the returns that they captured were really the behavioral mistakes that they made. And that was typically, buying the wrong thing at the wrong time, sticking with it for too long, and then capitulating and then blaming it on the asset class as opposed to the way that they behave. So there's been this dance over many, many dislocations over 25, 30 years, that there's been this dance between fear and fear of missing out. And that's what has constrained investors in emerging markets, not the returns that were actually available.
This is very high level stuff, obviously. I mean, you're dealing with currency plays, you're dealing with government change, you're dealing with, so public policy as well, foreign policy. Yet I keep reading that retail is going to get into alternative investments. What do you think about it? Is this for a retail investor? Should they be venturing into this arena right now?
Well, I mean, I think they're quite frankly, Charlie, they're already here. And they've been drawn here, in my opinion, in the wrong way. And what do I mean by that? So, if you're going to come into emerging markets debt, come into something that's liquid, you might as well just come into an ETF because you can change your mind overnight.
Right.
So the whole market is kind of drawn in or out via ETFs. But what do you get with ETFs? You get a collection of typically unsecured bonds that have a bond trustee and a collective action clause, which means you don't bake it and you don't work it out, and you basically get what others provide. And so retail has been told that that's safe, it's liquid, you can get out in one day, asterisk, that day may be when the market's down 20% when there's been a dislocation. And so, we've had a conversation with not only institutional investors, but, retail investors, which is if you're going to come into an asset class, you should take a better approach to that asset class. And it's interesting, in developed markets, people understand that. They understand that it's not just about yes, no. There's different currencies, there's different places in a capital structure to be, high yield, investment grade, whatever it may be. But when they go into EM, it's like, I just buy the index or I buy the ETF. And the problem with the indices in emerging markets is they've done more damage to emerging market investors than any particular event. And what do I mean by that? When I started Gramercy back in 1998, 99, Argentina was 18% of the
Yeah.
JP Morgan Emerging Market Bond Index. So somehow it was safe to be market weight 18%. And you could say that was a long time ago, but of course, in 2022, when Russia invaded Ukraine, Russia and Ukraine were about, I don't know, 800 basis points in the index. So we think the better approach is to take a high conviction approach to the asset class. You should vet everything you own. You should vet everything you don't own. What you don't own in emerging markets is equally important as to what you do own. And then the approach is anchor yourself in high conviction yield. You should be in emerging markets fixed income for yield. When you have high conviction, the opportunity cost of going to do other things is high. Those other things are things like distressed credit, opportunistic credit, special situations. And I think another mistake people make in emerging markets and probably other markets is they tend to allocate to these other areas, special, distressed, and opportunistic, when they're really not special, they're really not distressed, and they're really not opportunistic. And then they end up with a vintage effect in their portfolio. Sometimes it works, sometimes it doesn't. And I think it's because they lack that high conviction anchor in the portfolio to begin with.
So one of
So
the things,
go ahead,
so
Bob. Sorry.
yeah, sorry, Charlie. So one of the things that just struck me about what you were saying, Robert, is that uh, indexation in emerging markets is really not a great thing for investors. And in fact, that is the decoupling that people should be thinking about when they're thinking about developed versus emerging market. Indexation has really not done well for investors. You have to go to a specialist that has an edge, that knows what to do to give you that return you're looking for.
Right. There's indexation versus active, and then there's structured private direct lending versus public. And I think, the big opportunity that we found and where we become a leader in emerging markets is around direct lending, private credit in emerging markets. And when you think about private credit in emerging markets, think about private credit in developed markets 15 years ago, when you could really get high yields, you could really get collateral, you could really get uncorrelated collateral, i.e. things that have nothing to do with the business. You can do it in US dollars and you can get 1,000 basis points extra. So, would I rather own a Pemex bond at, I don't know, 6% over the last 3 years in the short end, What do you get? Unsecured, back to you get a bond trustee and a collective action clause, and it's liquid until it's not. And for that, you get 6%. Or you could lend to Pemex suppliers, get a Pemex guarantee, get collateral, get uncorrelated collateral, and get maybe 1,000 basis points over that. I'll gladly give up 12 to 18 months liquidity to get higher return and less risk.
Sure. No, and you go ahead, Charlie.
No, I'm fascinated by this because it's like it's speaking my it's speaking my book. I just think people have, you got to be specialized in these markets, and this sort of passive investing trend, I think, it's bound to blow up at some point. I mean, Bob, what do you think about that
Well,
broadly?
when? Well, I think Robert's point is, beta is the hardest thing to call, right? It really is. And what I think Gramercy tries to do is find those situations where they know you have an edge. And that is either guarantees, collateral, et cetera, all these things that are uncorrelated, that are the terms and conditions of the investment. That is where the edge is. It's not saying, hey, I understand market structure well enough to make a call on a general direction. So I don't see in US markets where you have, and this is something we specialize in, data is very interesting to us because we think people use proxy, they use things that are, for example, they'll use borrows as a proxy for short interest. They'll use holdings as a proxy for that are misclassified for whether someone's actually a daily market participant. And they're using things with super high latency. So you wonder why, when legacy inputs are the same, that people keep on repeating the same mistakes of position sizing in this market. And the reason why they do that is because 70% of anything that you look at in the stock market is owned by an index fund. So, what blows that up? Your guess is as good as mine. If I had that answer, I probably wouldn't be talking to you two guys. I'd be off doing that trade. But it's a great question. I don't know what makes active investing in a world where price discovery is almost zero, where you would unwind that structure. Something has to happen so bad that it just creative destruction happens and it blows up, and it's just not a viable model. And if that world happens, boy, we got a lot to talk about.
I was going to say, are we going to be on the air?
I know, Robert. That's my view. It's just
No, I would agree. I mean, I think there's problems with liquid beta in emerging markets because it's liquid until it's not. The problem with beta and ETF, if you will, an index-based approach to the asset class, if you look at the JP Morgan Emerging Market Bond Index over the last, I think it's 3.5, 4 years, we have assets that are down 90% and we have assets that are up 115%. So I would argue that not only is a target-rich environment for active investing, you're somewhere between negligent and grossly negligent if you take a passive index-based approach to that market.
yeah, I couldn't agree more. So speaking of which, let's talk about China for a second. Every time on this show we mention anything, even esoteric stuff about China, it gets white hot curiosity. I know you follow the property sector there very closely. What are your thoughts about the Chinese property sector, because it is so influential and important to that country?
Sure, I think China property, first of all, it's a great example of what we were just talking about, which is indices doing damage to emerging market investors. And if you go back 3, 4 years ago, if you are in an ETF or you're passive index, you have to own China property, and you own it at par, and you own it in a big weighting in an index. And the one thing that was clear about China property at par is that there was no property to collateralize that par bond. So now people are like, well, let's talk about investability. China's not investable. And I think the investability for us is, one, you always have to talk about an entry price. So, I would argue, there's probably nothing at par that I would want to buy in China today or 3 years ago. But when I look at this property sector today, there were over 100 property builders there that issued bonds. There's a subset of maybe 5, 6, 7 that are trading around a nickel that we think go through a debt restructuring, not a liquidation. And it's not going to be worth par. But if you can take it from 5 to 15 to 20 in a restructuring, that's pretty powerful. That's,
Yeah.
earlier we were talking about August 1998 and the Russian debt restructuring, the Russian default. And I remember, Russian bonds going down and trading at 6 cents, 5 and 11 sixteenths actually. And I remember being in Moscow shortly thereafter, in '98. It's like, this is not a 6 cent country. They have a space station. They have all the assets of the former Soviet Union. And the China property has, some. It doesn't match that, but it certainly rhymes with that. I think you just have 5 cent bonds that are just too cheap.
How do you know what you're getting if you buy in China? I mean, do you actually go to China to see the property?
We do, but we know what we're not getting, and we're not getting properties. So this trade is not about, we're going to take over the project and finish it and sell them. It's much simpler than that, which is you have these par bonds that went down and traded 5 cents. We're having conversations with the CFOs and CEOs. They're not talking about tossing the keys. They're not talking about liquidation. They're talking about what type of debt restructuring to do. And to Bob's point, you know, this sector is just too important to the Chinese economy. It's 25-30% of the GDP when the crisis started. So, and I think the intent of the government was, well, let's isolate Evergrande, which is where it started. That was kind of their Lehman moment, and let's insulate the rest of the sector. Well, how did that work? I mean, most of the sector's in default now.
Right. Exactly. So we keep on punting tariffs with China every 2 weeks. There's another 2 weeks. Now I think what's it, November 10th or 11th is the next deal.
I missed that. Is that today's news?
No, I literally just read that on air. I could have that wrong.
That's
I think I
amazing.
have it right. So what does that say to you, given the property sector is so important, given the conversations that you're having with folks that want to restructure their debt? And what is that speaking to you? What is that saying to you?
Well, look, I mean, I think that's a great example when you talk about tariffs, you're not going to have a homogeneous impact, even within a country. So first of all, when people say EM tariffs, what does it mean? Well, emerging markets is not homogeneous. So, it means something different for Mexico than it means for Brazil. Particularly when you talk about the weaponization of tariffs, it's not just about trade and what have you. It's about, hey, we don't like what Lula did with Bolsonaro, so we're going to create an extra tariff. But back to your question on China, I think we would be much more careful about sectors of China that we thought could be impacted by tariffs, or embargoes, or protection as it relates to technology, defense, what have you. I don't think, although President Trump has a real estate background, I don't think he really cares to tariff two or three or a handful of home builders in China. So we've done the work. We don't think this sector is going to be affected by tariffs. This sector has its own idiosyncratic domestic issues that have to be underwritten.
You guys have any, because this comes up on the air a lot. There's always debate. Tariffs are going to kick in at some point. I mean, you look at this stuff. Are they going to kick in? Are they sort of
Meaning the
softening?
inflationary impact of it.
Yeah, I mean, in terms of inflation. And by the way, maybe it's stagflation. I have no idea. But are we going to get something from this? Because right now, it's obviously not. We're kind of like in a period of stasis right now.
Look, I mean, I think there's this tension going on between the impact of tariffs and the impacts of technology and AI, right? And so if you look at tariffs in isolation, you would say, well, eventually one of two things is going to happen. Either there's going to be pass through of the additional costs and we're going to have inflation, or we're going to have margin compression.
Right.
But we're not looking at this in isolation. We have technology, we have productivity gains, we have artificial intelligence. So I think there's this dance going on between those two things. And again, I don't think you can look at it on a blanket basis. You're going to have to look at it, sector by sector, country by country.
What do you think we
And
learned from the early 90s when Greenspan looked up and said, hey, look at all this productivity from the internet? It offsets, we've never seen full employment with this kind of inflation number. What do you think the white paper world learned about how to measure productivity given what AI can do? And I know that's a much bigger answer, and I don't expect an off the cuff response.
Yeah.
But do you think we've learned something from 20 something years ago? You have so much experience going through all these crises or inflection points for policy. What do you think about how do you measure that offset, given that tariffs is a kind of a VAT? And now you have all these software companies laying off coders, increasing margin, and potentially increasing productivity.
Yeah, I mean, this is probably an entire show on its own, but
Yeah.
I think the impact of AI has the potential to be exponentially more than what the impact of what we were looking at in the early to mid 1990s or late 1990s. One of the differences between, you know, and maybe you were going there, maybe you weren't, but the 1990s, so many of these four-digit stocks, and they would combine and they would triple in value. I mean, there was just a bubble, and it was a bubble that had some debt underneath it. When you look at these companies today, they're well capitalized, and they have runway. And I think the productivity gains are going to be materially more than what we saw from the 1990s, and the speed of the change from AI is so much faster than the speed of the change from the, shall we call it the evolution of the internet that we saw back then.
And
Yeah, I
isn't
mean,
that,
half
but
those
isn't
could.
that, sorry, Charlie,
Yeah,
isn't it ironic though that and this is something we've been grappling with and I've been grappling with, which is, okay, we survey the economy on a cord phone. We hand out literally paper surveys. And yet you have something like AI that is something that is real, that is capital backed, that is working at the speed that is almost incomprehensible. And we wonder why there's a dislocation. And we wonder why there's this confusion between, hey, are tariffs inflationary versus the offset you have with AI? And it's just fascinating to me because BLS cannot capture this change. That's what I was trying to get at, is that our mechanisms for capturing this change are so antiquated compared to what the productivity gain is.
Correct. Earlier we talked about the change in the state of nature that comes with regime change, right? It's a completely different policy set, so you can't look at it the same way. I think there's a parallel when you talk about AI, that there's just a complete change in the state of nature. And the way that we used to think about, collect data in the past is going to look foolish in the future.
although suppose it doesn't live up to the hype. Is that a
Well, but
possibility?
Charlie, but here's the thing, right? So why isn't there a Oracle? And we've said this on the show many times. Everybody has an iPhone. It's crazy to me we don't have CPI by the second everywhere in the
Yeah,
world.
yeah.
It can be done. So if you did that and actually had a statistical measurement of what the impact of AI is, maybe it might actually quell a lot of the uneasiness and some of the political fervor that we've seen, right? I think, on a lot of the I'll say political uh, statements that we see in
The
big cities
populist
versus,
political statements,
yeah,
shall we say.
populist political statements are from that unease. And if you could actually explain it to folks and say, hey, you know what? We can actually measure what this means.
Well,
It
maybe we can't.
might get,
Robert, maybe you can get into this. Maybe we can't explain it because it's really not doing that much now, or maybe it is. I can't tell.
I think you look at Salesforce and you look at some of these, it's doing something for sure. And it's very dramatic. And it's
Robert,
giving insight.
you want to
So
weigh
I'll
in
give
on
you an
that?
example. In our own business, I can get insights into behavior, into P&L projections that even your best data scientists cannot do every single day, all day.
Okay.
There's just the third eye there that's unique if leveraged.
Yeah, and look, we're a boutique investment management firm. We're not BlackRock, we're not JP Morgan, but we're finding that through the use of AI that we can bridge the gap between what they're doing and what we can do. And I think someone said to me the other day, like we're in the second or third inning of AI. I don't even think we're out of the locker room yet.
Yeah,
Really?
I totally agree with that. I totally agree with that.
Well, maybe the towers will be a big donut.
Could be.
That's true.
It could be.
Robert, we got 2 minutes left. We really appreciate your time. Any parting thoughts that you want to get across?
No, I mean, I think talking about this approach to emerging markets, a beta agnostic approach to emerging markets. I think one of the most important developments in emerging markets has been the rise of private credit. And private credit in developed markets, I think, is getting old, it's getting tired, it's getting competitive. You're having a decrease in lending standards, a decrease in expected returns, higher leverage. And what we're seeing in emerging markets is quite different. That it's not competitive. We're not seeing the large credit shops that are running around. People aren't throwing term sheets around. If a borrower says, hey, we've seen a term sheet that has better terms than yours, we're like, then we're just not the right lender for you. Good luck. But this is an important tool in the toolbox for emerging market investors that they're familiar with in DM, but they're not using in EM. And I'd say the other thing is, we see these BlackRock, HPS as an example. Everyone's talking about these hybrid portfolios and what Apollo's doing. And we kind of laugh over here because we've been doing these hybrid portfolios in emerging markets for almost a decade. And it's not because someone said that that's what we're supposed to do and that's where the market's moving. It's because it's the right way to get returns out of emerging markets.
And is it fair to say, because we do have global unrest, there are opportunity zones here that we can play off of?
Look, the global risk, the uncertainty, the volatility, that makes it a lender's market, right? It's like we can get, I was just in Turkey, lots of uncertainty, a lot of banks constrained. If you have good structure, good collateral, you can get good returns, and you have pricing power. That's a place you want to be.
Robert Koenigsberger, thank you for joining us. Come back. Fascinating stuff. I learned a lot today.
Thank you.
Robert, thank you so much.
Bob, amazing discussion. Learned
He's
a lot.
best. What a thoughtful guy, right?
Yeah, I'm glad I kept my mouth shut.
What a really thoughtful guy, and we always try to bring people that are thoughtful and can actually make you look at the world a little differently.
Yeah, and help make you money. I mean, that's kind of where we're here. I mean, we're not here to just, pontificate, and because that's kind of not what we do. We try to provide actionable data. We don't tell you how to do it, how to use it, or what to do with it. But the data and the information and the opinions we reflect, you really can't get anywhere else. I really learned a lot about his outlook on emerging markets, which, and everybody. I mean, listen, we talk about stocks, you and I, and different investments all day. You don't hear emerging markets come up that much, and he explained why you need to start looking there. There's global tensions. Those global tensions create volatility. When you get that, there's an opportunity, as he said, to lend, which means invest, through credit markets, and it's just fascinating stuff. And he also said, if you do your homework and you're in retail and not a professional trader, this is for you. But you got to know
There's
your
room. I
stuff.
mean, that was a great conversation. I mean, we covered Venezuela, indexation, terms and conditions, tequila crisis, next crisis, China property in about 22 minutes. So that was a really action-packed, great interview. Charlie, you're the best.
And Bob, thanks for bringing him on. And, thanks for being you, the daddy of data, Bob Sloan. I'm Charlie Gasparino from the New York Post and Fox Business. Bob, as everybody knows, from S3 Data, which I am an honorary, I guess, employee at this point. We'll see you next week. This drops every Friday, and we come out with a new episode every Friday. Signing off now.